Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark talks about the volatile markets following Brexit. Sprott U.S. Holdings President Rick Rule says we're seeing a rare summer metals rally. Institutional Advisors investment strategist Bob Hoye believes leaving the EU could benefit Britain's economy. We'll talk to Ross Clark right after this.
GEM International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond, recently discovered in Africa by a fellow Canadian junior, with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Well, this was another one of those exciting weeks, Jim.
Well, after Brexit, everybody predicted such a huge disaster, yet by the end of the week, it seems like most of the markets recovered.
Well, yeah, recovered, and in some cases actually better than they were. Maybe not necessarily as of Thursday prior to the Brexit vote concluding, but at least prior to the Wednesday beforehand, because the markets had been rallying in anticipation of the Brexit moving just the opposite way. So clearly the markets were vulnerable from the highs that we'd seen on Thursday's close a week back. But you know, the key here is that when everyone has these pent-up anxieties regarding a scheduled announcement, whether it be geopolitical, whether it be military, the probability of seeing major follow-through after the event is just not there. And in particular, you know, you think back to after the crash in 1987, the U.S. administration through Reagan came up with this working group on financial markets, which otherwise is known as the Plunge Protection Team, that was put in place to create liquidities during times of duress in the marketplace. And in the last decade, that has expanded to the point where there isn't a central banker in the world that isn't doing whatever is necessary to provide liquidity when you see market action such as we saw a week ago Friday and again on the Monday morning. And so there, you know, and the Mark Carney, the governor of the Bank of England, I mean, he came out almost immediately after the vote saying that the economic outlook was deteriorating and that some monetary policy was going to be required over the summer. I mean, he's immediately stepping up to the plate. And you know that Mario Draghi, everyone at the ECB is going to be doing what they had to provide stability. Now, it doesn't mean that they can make the markets move up indefinitely, but they are there when those points of extreme, such as we saw on Friday and Monday, come to a peak. So, you know, you catch a lot of people who have been selling into after the news, a number of those who would actually be looking to take short sales, anticipating that will be follow through, and you catch them all off guard as you start to rally back. So, you know, by the end of the week, basically we're unchanged over a 10-day period.
Interest rates are now at a record low in the U.S., and other places lowered their interest rates as well.
Yep, you know, you've got yields, France, UK, Japan, Netherlands, all at record lows. U.S. mortgages down to record lows. You know, a U.S. 10-year government bond yielding 1.4% at this point. When we take a look at the long-term movement here, we've been in about depending upon whether it's the 10 or the 30-year bond, we've been in a 30 to 35-year downtrend in interest rates. The bottom of that channel is about 1.3%. We're getting very close to that. And once you hit the bottom of the channel, you tend to get a pretty good uptick in rates. The other side of the coin is the long bond, which has got up to 175 in the U.S. Looks as though From here, maybe there's a pretty good chance of a top, but ideally if we got up to about 182 in the long bond. And if it gets overbought, if we've had this flight to safety and we see a bit of a reversal from there, I think you could start to see the credit spreads widen out. You see a flattening of the yield curve, which has become very steep here in the last couple of weeks again. And that might set up for a summer high as far as the equity market's concerned. And I had been looking for and talking about the seasonality aspect regarding election years, how typically you would have that May bottom, early June, and do a bit of basing out for a rally into the middle of the summer. So with the exception of that quick break under the May lows that we saw here at the beginning of this week, and then the quick reversal back up, it really looks as though that mid-July to early August is a reasonable time frame to be looking for a high in here, because all this liquidity that's being put in right now provides some stability, but not necessarily for the long pull.
What's gold looking like?
Well, gold did exactly what you'd expect to see on a news item that is pretty much baked into the cards. When you get either conflict from a military perspective or from a geopolitical or an economic one that is a known item, you'll tend to top out very quickly, literally within hours to maybe 48 hours at the most. And in our case, gold in the week prior to the Brexit had eased off from just over 1,300 down to approaching 1,250. And overnight, we saw prices rally 9% up to the 1,362. And the norm on an event like that is that gold will create a high that will be up to 10% beyond where it had been. So this one was very, very close to the optimum number. And then you will see it sell off. Now, the norm is that it would sell off for a period of weeks, because the excesses that are created by those coming in on the final push, those need to be cleaned out. But the overriding factor from a technical perspective here is that breaking through the 1308 level, which had been for us a pretty important resistance after that long consolidation, that February through end of June consolidation.
Ross, thanks for chatting with us.
Nice to be with you, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. His email, ross.clark@cibc.ca. Coming up, Sprott U.S. Holdings Incorporated President and CEO Rick Rule on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Rick Rule. He's the president and CEO of Sprott U.S. Holdings Incorporated in Vancouver. Welcome to This Week in Money, Rick.
Pleasure to be with you. Thank you for having me on.
The Sprott Symposium is returning to Vancouver this month. When is it? Where is it? What can people expect, and how can they find out more about it?
July 26th through 29 at the Fairmont Hotel, Vancouver. I'm pleased to say this is the 25th year that the symposium has been held in Vancouver, the third year that we've had it. We believe, and many repeat attendees believe, it's the finest retail natural resource investment symposium that's put on in the world. I guess it stood the test of time with 25 years duration, all through the bad markets and all through the good markets. Some great speakers this year, including the man who's currently the most popular speaker in the gold circuit, Mr. Jim Rickards, who did such a wonderful job of forecasting the current rise in the gold prices from its doldrums last year, a wonderful geopolitical expert, former general counsel to long-term capital management as an example, so well-versed in financial circles, but also a CIA analyst. Of course, Doug Casey comes back, Robert Friedland, the usual cast of characters that we featured at this conference over 25 years. What I'm particularly proud of at this conference is the fact that our attendees have told us that they consider the exhibitors to be content too. You know, at most conferences, the exhibitors are advertisers, and the criterion for choosing exhibitors is a pulse and a check that cashes. Our attendees have told us that exhibitors to them are investment opportunities, in other words, content. And to that end, there is no public company exhibitor at the conference that is not owned in a Sprott Inc. managed account. That doesn't guarantee that they all go up in price after the conference. It does guarantee that we know them all well enough to have invested in them ourselves. So we really look forward to seeing as many of your subscribers and listeners and readers as feel it's appropriate. We think there's going to be a lot of opportunity, and we think there's going to be wonderful content from the podium.
How can people find out more about the symposium?
The easiest way, I guess, is to go online to Vancouver Investment Symposium or www.sprottglobal.com. We can also forward you a link if you'd like to put on your site that'll be concurrent with this. But it's pretty easy. Just going on the web to www.sprottglobal.com will certainly get you there.
Does it look like the metals and metal stocks are having a rare summer rally?
It has been rare, and I think the only way that you can explain it is that they had sold off so much in the last 4 years. You know, the arithmetic behind this is pretty compelling. The TSXV resource index was off by 90% in nominal terms. Now, if you think about that, that's a market that fell by half, and then it fell by half, and then for good measure it fell by half again. A market that is off 90% in nominal terms, that then goes up 100%, is a market that's still down by 80%. So this market has room to run, assuming that the metal cooperates, and the metal seems to be, today, to cooperate.
At this point, are you more bullish on gold or silver?
I have to say right now I'm probably a little more bullish on silver, but that's for speculators. You know, the investor will always go for gold, because the investor is looking at preservation of capital. The speculator is a different breed. In my own experience in prior bull markets, gold always leads, and then silver follows through. Gold has certainly led, but silver has a long, long way to run, I think.
How good of a prospect are junior gold miners? They've had such a rough ride the last 4 years. I've seen some offices go from a staff of 50 down to 1 or 2 people. Are they lucky to still be alive, and now would they be a good deal?
Well, I think they're not all created equal. You know, we've talked on your show before about the fact that there's probably 1,000 so-called mining companies in Canada, and probably 800 of the 1,000 are pretend mining companies. But the real mining companies, remember the arithmetic we just went through. The market was off 90% in real terms. It's recovered by 100%, so it's still down 80% in real terms. They have a long way to run. But the critical part of this is going to be stock selection. Not all of them are created equally.
If you had a chance right now to take a look at what might happen to gold and silver, what does the rest of the year look like?
Well, it wouldn't surprise me to see them settle off. You know, nothing goes straight up. I must say, however, our investment strategists, our technical analysts at Sprott, say they're going higher still. In the near term, I can't really say. What I think I can say in the longer term is that the pieces are in place for a sustained gold rally. Here's why. A lot of studies have shown that the most important factor in determining the gold price for the last 40 years really has been that it trades mostly inversely to the U.S. dollar. And the U.S. dollar expressed by the U.S. 10-year Treasury, the world's benchmark security. The U.S. 10-year Treasury has been in a 35-year bull market. The rate has fallen from above 15% to 1.4%. Now, by any arithmetic measure, that means that the U.S. 10-year bond bull market is much closer to the end than to the beginning. And if you believe in inverse correlation, which has been shown statistically, that means that the gold bull market is much closer to the beginning than the end. I also think that there are other factors at play that are related to this. The very low interest rates, of course, are a function of this long-term gold rally, but they make competing instruments in the fear trade, that is government debt, much less attractive relative to gold. And finally, with Brexit, it would appear that these artificially low interest rates and the stimulative instincts of the central banks will be increased, not decreased, which is also, of course, good for gold. The only thing negative I can say about gold is that it's run from 1,100 to 1,300. In other words, part of the rally is already over, but I think the best part of the rally is yet to come.
Is the uncertainty caused by Brexit and the upcoming U.S. election good for gold, silver, and their stocks?
Experience has shown that uncertainty, financial uncertainty, is always good for gold. Silver is more speculative. The thing that could hamper silver would be any kind of liquidity crisis like we saw in 2008. Historically, of course, gold leads and then silver follows, but silver goes further than gold did. So if past is prologue, as I say, the investors will look to gold, the speculators will look to silver.
You're listening to This Week in Money. I'm Jim Goddard. We're speaking with Rick Rule, President and CEO of Sprott U.S. Holdings, Inc. in Vancouver. Taking a look again at what's going to be coming up with your investment conference, what do you think people are going to be asking about the most?
The questions that I'm really looking forward to handling, given that gold and silver are so popular, will be questions surrounding the other materials in the world. Things like copper and zinc and nickel and coal and uranium and oil and gas. I believe that 18 to 24 months from now, we're going to be back into a general commodities bull market. That is, with gold, silver, and other commodities going up simultaneously. And positioning yourself to take advantage of the beginnings of those bull markets, I think might be even more lucrative, even if not as immediate as the current run that we're having in gold and silver. So I think what will be interesting are discussions that take place alongside the gold and silver discussions, which will, of course, certainly be more prominent.
Do resource companies with properties in the European Union now have an added political risk component?
I'm not sure they do, but I think their cost of capital is going to go up. I think perversely that the Brexit discussions may make continental Europe a bit more investment friendly, simply as a consequence of the political powers that be wanting to show themselves to be non-confrontational. But the truth is you have to be on very speculative grounds there.
Yes, as we know, when things get a little shaky, investors tend to run the other way until everything settles down. Some of the analysts I've talked to believe that Britain made the right decision to get out of the EU because now it'll cut a lot of the red tape that's held them back in areas they'd like to improve their economy on. Plus, the British economy right now is not doing that bad. They have record low unemployment.
I'm not a political analyst. I need to say that certain aspects of the Leave campaign were, from my point of view, extremely distasteful. The anti-immigrant rhetoric, the outright racism displayed by some of the Leave camp. Having said that, I suspect myself as a citizen would always vote to dismantle any level of government. It would have been interesting had you given the British voters a choice between dismantling the British government and the European government as to what would have happened. So my suspicion is that having to deal with one less level of regulation will be good for some businesses. Now, the other part of that, of course, is that the Leave vote removes the Euro passport of the British financial services industries, the banks and the investment banks. And life will certainly be more difficult for them without an automatic advantage in continental Europe over banks from other parts of the world. And I would expect, if Brexit actually occurs, that London's position as a global financial center will be measurably weakened. So I wouldn't want to be a holder of British financial services stocks in this consequence.
Are there regulation hurdles for Americans who want to invest in Canadian junior stocks?
Yes, of course. We have the worst of all worlds. We have to comply with Canadian securities regulations and U.S. securities regulations. We at Sprott have 30 years experience in doing just that. It ends up for us being a sort of a durable competitive advantage because we've done so much of it. But the truth are that there are regulatory hurdles, one of which, of course, is the U.S. one-year holding period. So if an American client buys a Canadian private placement, unless the American client or his broker knows how to deal with the restrictive legend, the Canadian placee is free to trade in 4 months, while the U.S. placee is restricted for 12 months. There are ways around this, but you or your broker has to know how to do it.
With the tragic forest fires in northern Alberta and Saskatchewan, is that going to put uranium exploration on hold?
I don't believe so. Most of the uranium exploration that takes place in Canada is taking place in the southwestern quarter of the Athabasca Basin. And the existing fires aren't problematic, although there's always a possibility of new fires. But if it happens, it will be fairly short-lived, and the incredible exploration success enjoyed by Fission and NextGen, I suspect means that the next 2 or 3 field seasons in Saskatchewan for uranium are going to be very busy, despite not record low, but really, really painfully low prices in the uranium business.
Is it good or bad news that the so-called three amigos, the presidents of Mexico and the U.S. and the Canadian Prime Minister, have agreed that we should have sustainable energy sources in 9 years?
There's no good that can come from a meeting of 3 politicians, 3 big politicians, especially those 3. Mercifully, you can tell that any of them are lying when their lips are moving. So I wouldn't suspect that their big policy pronouncements mean very much. It probably means that the cost of capital for solar and wind projects goes down. But I wouldn't suspect that pronouncements from the 3 amigos, none of whom probably could have spelled energy 10 years from now, will have any lasting impact on the market.
Does this give people new opportunities to look at alternate energy sources? Because right now, you always hear it's too expensive to develop them right now.
Well, there are extraordinary subsidies in place for alternative energy already. The fact that there is explicit support for them, again, probably reinforces the lower cost of capital, and perhaps it reinforces the government tendency to subsidize wind and solar, without which there would be economic concerns in some places. The subsidy on solar, as an example, in Ontario is extraordinary. The industry probably wouldn't exist without it, and it would. One would suppose, I guess, as a consequence of the announcement from those political groups, that those subsidies and that favoritism, and hence the lower cost of capital, will continue.
There's a controversial proposal, of course, to build or twin a pipeline from Edmonton to Vancouver to move heavy crude. Is that pipeline needed, or is it redundant with all these moves towards alternative energy?
I think it depends on who answers that question. I don't think that the global oil business, the global oil market, needs it particularly, but I think it would be of benefit to Canada, and of course it would be of benefit to the Canadian producers. I think that having more outlets for Canadian hydrocarbons, given the political unpredictability of the U.S. with regards to hydrocarbons, would be a good thing for Canada. And I also believe with proper First Nations consultation and participation, something that sadly we haven't been used to for a very long time, that it's politically feasible that pipeline could be built. But I think a lot more community work needs to be done. The truth is, in Western Canada, in resource development, that we have ignored traditional stakeholders, that's a fancy name for First Nations, for a very long time. My own experience with First Nations communities in the last 5 years is that they have a lot more financial sophistication than they have been given credit for. And more detailed consultation and better participation by those same First Nations group could probably overcome a lot of the social and political opposition to the pipelines that have held it back so far.
I think one of the biggest drawbacks to the pipelines is the fact that they still don't have a real super good response plan if there's a spill. You have the Burnaby fire chief saying if they put more storage tanks in, he doesn't have the facilities to fight a fire there, so why haven't they proposed having automatic firefighting systems? Little things like that could maybe change the public's mind.
What I think is the biggest consideration socially and politically is how you get the oil from Edmonton to Burnaby. If you told Kinder Morgan that they were going to get an extra 300,000 barrels a day of capacity if they could solve the fire marshal's concern, believe me, it would take their engineers 10 days to solve the fire marshal's concern. From their point of view, the biggest challenge that they face is the political opposition to twinning the pipeline from affected communities in the pipeline route.
Rick, I mean, let's be honest here. You're a billionaire. You've worked very hard all your life to pile up the assets in a smart way. The question people have always asked is, how did you make your money?
Well, firstly, I'm not a billionaire.
Okay.
I mean, I think it depends on the currency that you measure me in. You know, maybe in Zimbabwean kwacha or something like that. I'm only an aspiring billionaire.
Well, that's a good goal.
But I made money, I guess, 4 ways. I worked very hard, which somebody must do to make money. I've aligned myself with fantastic people. In the resource business, I was fortunate enough at a young age to begin to hang out and invest with the Lundin family, with Robert Friedland, with Bob Quartermain, with Ross Beatty, with people who became, Pierre Lassonde, people who became legends in the Canadian resource industry. I learned after my initial boom in the 1970s that resource industries are extremely cyclical, so I learned to be a contrarian. I learned to write big checks in years like 2014 and 2015 so I could cash those checks in 2017 and 2018. And I learned that the most frequent outcome in exploration is failure, but that the successes pay so much more than the failures cost you that ultimately it's a good business. But to exist well as a speculator, one must have real tolerance for pain, which I've come to have.
And Rick, again, could you maybe just remind folks about the Sprott Symposium? Where is it, and how can people go there?
Yeah, we'll forward you a link for your own site, but it's easy to go online to Vancouver Natural Resource Investment Symposium or www.sprottglobal.com. The conference takes place July 26th through 29, inclusive, at the Fairmont Hotel, Vancouver.
Rick, thank you so much for being on This Week in Money.
It's always a pleasure. Thank you for including me.
My guest has been Rick Brule, President and CEO of Sprott U.S. Holdings in Vancouver. Coming up next on This Week in Money, market historian Bob Hoye.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
We're chatting with Bob Hoye. He's a market historian and the chief investment strategist for institutionaladvisors.com. Welcome to This Week in Money, Bob.
Jim, it's very good to be with you and with the listeners.
Bob, of course, Brexit, unprecedented. Can you recall any other big market shakeup like this where a major player in an economic union or trading bloc has decided to pull the plug?
Well, you know, I can't. I've been thinking about it. I've been fascinated by it. And going into the vote on the 23rd, I could see a number of reasons why Britain should leave. But I wasn't bold enough to say that the vote would go to leave. I just thought it might be so tight. But anyways, the vote did go to leave, which I applaud. And the reason being is that over a period of history, you've had, let's just only go back to the Napoleonic period, where Europe can get involved in some dreadful experiments in authoritarian government. And then the Brits come along, which Napoleon described in the 1820s as a nation of shopkeepers, and they defeated him. And then again in World War I and World War II were due to experiments in European love of authoritarian measures. And then through the subtlety of this European Union, European community, whatever you want to call it, this I've said many times, is that the idea of free trade is terrific, but you didn't get so much of free trade. You got a managed trade arrangement, and managed by an ever-growing bureaucracy in Brussels. And that bureaucracy pays itself very well and has minimal taxes and all kinds of travel expenses and stuff like that. So it's doing what any bureaucracy would do. If given the license, it will thrive. The results are secondary. So anyways, so the irony is that should this unaccountable and unelected bureaucracy to continue its way, which it will, then it's effectively a takeover of England by an authoritarian monster. So, and this, of course, hasn't happened to England since way back in 1066 when William the Bastard moved over and conquered England and brought in feudalism, which was a severe authoritarian form of government. So England, I look at the vote as mainly to protect the supremacy of Parliament and secondarily to protect the freedom of the individual. And, of course, big governments and the media that back big governments really don't like this. So very exciting things, and we'll just see how it goes. Of course, the powers that be in Europe were quite petulant about it, and we're going to punish England, which is an unwise start on their part. But, of course, this could prompt other countries to make the same move, and that would be a good thing, too. It's going to be disquieting to the system the way it works now, but the threat from an unaccountable bureaucracy is absolutely terrible. And if you look at Europe's history, any experiment in authoritarian government has gone to bringing in the privilege of state murder. So to wrap it all up, leaving Europe would be a very good thing. Having the various dissatisfied member countries leave would also be a good thing. Then it gets to be a problem. What are you going to do with all those bureaucrats that have high incomes and privilege? Well, we should go back to the Soviet Union when their apparatchiks and nomenclature had all the perks and privileges. And when the Soviet Union failed, those bureaucrats, I guess, had to go and find real work. So let's enjoy it as it happens.
George Soros has called Brexit a slow economic crisis. Do you agree?
I think that it would be associated with an economic crisis rather than causative. You already have had the top of the bull market for equities using U.S., the main market. In May last year, you had a very good sell-off in where we follow the NYSE comp, the NYA, and we down to an exceptionally oversold in January, February. and then a very good rebound out. Now, the one that we used on this rebound, which is both a target, is different moving averages for the different indexes, whether it's the banks, which we covered a week ago, got up to the appropriate moving averages and have been turned away. And then we're looking at the transports, which provided the lead to the high in May. The transports were not confirming what the Dow or the S&P were doing, so that then in May said that the bull market was over. And then on this rebound, the transports again are non-confirming, so it's merely a rebound within a cyclical bear market. As a matter of fact, Jim, this is the second big rally since the bear market started in last summer. And it shows a chart pattern with resistance and moving averages that are very similar to the second rebound in the 2008 bear market and also the second rebound in the 2002 bear market. And we're not making this up. You just look at the charts and the appropriate moving averages, and the rally came up to resistance and backed off. So now what we've got here is that on Friday and Monday, the financial world thought that the financial markets were, failing, that this was a dreadful dislocation, which it is. But it'll be on the political side with the EU, it'll be a slow dislocation. And what we're more interested in is what the market's doing on the near term. And again, I would be very reluctant to try and explain the last week of action in orthodox terms about what the Fed or the Bank of Canada is going to do or what the EU, European Central Bank, is going to do, because they haven't got a clue what to do. They're merely along for the ride. So this is where we fall back onto well-tested and well-proven technical tools, and they're there, and they're a great help in times of volatility. When you're on a straight line trend, either up or down, that's one thing, but it's in the transitions whereby technical tools become very handy. And this is the rally out of January, February has been accomplished. It reached our targets, and it is also failing at those targets, which is important. So I think the next few trading days will be choppy. They've got a lot of short covering going on. The trading volume with the rebound out of Monday's disaster has not been that robust. So let's take it as a quick bounce, and probably in a week or so, the main index we follow, the NYA, would be rolling over. And then you've got Europe. It's in their stocks index is in worse shape than the North American ones. So, yeah, it doesn't look good. We've also had, with the rebound out of the disaster into January, you've had a terrific rally for low-grade bonds, high yield, junk, whatever you want to call it. And it reached a critical moving average and resistance. So that one looks eligible for a sell-off in all of the higher yield instruments. This then gets us into the credit spreads, which is the difference between high yield stuff and high grade stuff and low grade bonds. And in times of confidence, that spread narrows, and we've had widening down into January. February was extremely painful, and now you've had a terrific narrowing, and the first part of it was driven, of course, by it being such an extreme disaster into January. And then more recently, you can often get a seasonal effect whereby credit spreads will narrow into around June, and they have. But in looking at the chart on the CCC spread relative to Treasuries, let's put it this way, it stopped narrowing and is attempting to bottom, and there are a few little technical things yet to come into play here before you can say that spreads are back to widening. And Jim, this has been very important. You recall that in 2015, last year, that was one of the critical elements where we got the reversal in June, and then we were looking for the breakout in widening credit spreads. And that's, I believe, pushed off the major sell-off down into the fall.
We'll have more with Bob Hoye next on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. So, Bob, we were talking about credit spreads. Why should we be worried about them?
The trend reversal in credit spreads is very important because it will put a lid on any advance in commodities, and it will roll the stock market over, and the next leg down would confirm that indeed we are in a cyclical bear market. And with this, we would likely get a firming U.S. dollar and trading range for gold, and with some financial pressures later on in the year, silver could fall relative to gold.
Is gold going to be the really hot item as we get nearer to the end of the year?
Well, we should look at gold for what it really is. Number one, it's money. And number two, it provides a liquid place to park when market conditions are frightening. And then, of course, that is also the feature of the senior currency, which is still the U.S. dollar, that it is the most liquid item. And when you're in a financial storm, the serious money goes to liquidity. It doesn't care what kind of a return you're getting. So this is what then would have a tendency to firm the U.S. dollar up, but then the same flight to a liquid item, which is gold, would firm the price up. But if you got gold, the dollar going up and gold going up. So there could be times when, in extreme distress, when gold and the dollar could both rally at the same time. But our guess is that the rally for gold may not be as robust as some people think when you're in times of trouble. What could do well, of course, is that with gold outperforming the price of crude for the last year or so, this is really helping operating costs at mines. Their margins are improving. So let's put it this way. Traders should trade gold from overbought to oversold and back again. And investors should be looking at the gold stocks as they become, in a post-bubble contraction, the premier industry. The one industry that really does make money in bad times is the gold mining, because the most commodities and wages and whatnot decline relative to gold. So even in the 1930s, the gold industry was outstanding, and we are the low for gold at the turn of the year. We took as a cyclical bottom for the gold sector, and the huge rally confirms that. We've been in sort of a sideways correction mode for a while, and then recently strength came in again. But this is within a new cyclical bull market for the gold mining sector, which we welcome. It'll be terrific.
The Toronto Stock Exchange will enjoy its second quarterly gain, and apparently the Canadian stock markets have recovered about 2/3 of what was lost after the Brexit panic.
Yeah, well, you've also, since the January disaster, you've had a very nice recovery in base metals prices, and that put the base metal miners up. They've moved very well, not quite as strong as the golds. And then you've also had the brilliant rally in crude oil up to the $51 level from 26. And this is good, but it's sort of toppy in here for crude oil. We've been calling for a correction for a while, which it has been since the 51 plus change level was reached. And the correction can go on for a while yet. There could be little rallies, but when you look at when the widening credit spreads are confirmed and you got spreads widening, that's the item that can push off liquidity problems later in the year.
Bob, if there was anything you could say to try to describe the Brexit panic and so on, what kind of words would you use?
I'd say that the markets were primed for disturbance, for a hit. The change that England is upon, I think, will eventually be very constructive for England to have its own sovereignty back. And then also the diminishment of unaccountable power in the bureaucracy in Brussels would be extremely healthy politically. So it's going to roil the markets because there are many people in Europe who really like authoritarian government, but as we look at their record, every authoritarian government has eventually become murderous. So any diminishment in Brussels' power is a good thing.
Bob, thank you very much for chatting with us.
Hey, Jim, it's good to be with you.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. That wraps up our show for this week. I'd like to thank our guests, Ross Clark, Rick Rule, and Bob Hoye, and thank you for listening. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.